Of course, today is the 8th of December, the day when the RBI governor is set to announce the monetary policy decision that was made by the MPC earlier this week. We will expect a pause decision by the MPC because that is what 43 out of 44 economists polled by Bloomberg are estimating. What we also expect is that the withdrawal of accommodation stance that the MPC has been having for the last few policies, that is likely to continue as well. However, the expectation is that the RBI governor will sound a little more hawkish than usual. Now, I'll tell you why. Basically, when we look at the CPI inflation number, which is the inflation number that the RBI tracks, that came in at about 4.87% for the month of October, which is within the RBI's or the MPC's tolerance band of 4 plus or minus 2%. So that's probably a good sign for the RBI governor. What the other good sign to watch out for is, of course, the GDP growth numbers, because those have come in for the Q2 numbers have come in quite strong at about 7.6%, largely being driven by the manufacturing industry. So those are all good signs that work in favor of the RBI wanting to keep the monetary policy a little tighter than usual. So while there will be no rate decision as such expected today, we are expecting some announcements on the liquidity front. The RBI will intend to keep the liquidity position tight because that, of course, has an impact on how the market borrows. So therefore, what we do expect later today at 10 a.m. when the RBI governor delivers his speech for the monetary policy is that there's going to be a tighter monetary policy decision. Liquidity is likely to be tightened further, and rate decision will continue as status quo.
Okay, just seconds away from the RBI governor starting to start speaking. Keep in mind, if you want to just understand what could be the factors behind, we did a very extensive chat with Lakshmi Iyer and Indranil Sen Gupta at 8:10 or 8:15 a.m. today. So that will help. But in a nutshell, expect the Reserve Bank of India maybe not to be too hawkish, even though they have the arsenal to do so because the GDP numbers are looking okay. The point is, crude prices are no longer as high as they were maybe a couple of months ago and putting pressure on external finances. The global yields have come off, and that is a bit of a tailwind as well. So maybe, just maybe, despite our own food inflation likely to stay elevated, there is room for the Reserve Bank of India to sound a bit more cautious as opposed to hawkish in that sense. And frankly, the rate decision is a done deal. They'll come up on your screen in just moments from now. So the rate decision is a done deal. I'd be really surprised if there are changes to the rates per se, but it is all be in the commentary. The governor on your screens, he'll be about to start speaking, and we'll get to know. Let's get across.
We are now into the 8th year of our monetary policy making under the new inflation targeting framework. If you remember, this was started in October of 2016. So 7 years are complete. We are into the 8th year. And on a personal note, if I can seek your indulgence, this would be my 32nd monetary policy, including the off-cycle meeting last year and a special meeting. And at the outset, let me also wish each one of you a very happy new year in advance. And this is how the statement reads. As 2023 comes to an end and a new year begins, the long-awaited normality still eludes global economy. The years 2020 to 2023 will perhaps go down in history as the period of great volatility, comprising a host of black swan events in quick succession. The global economy is showing signs of slowdown, though unevenly across geographies and sectors. The emerging market economies, that is EMEs, as a group have remained resilient during the current bout of volatility, unlike previous episodes. While headline inflation has receded from the highs of last year, it remains above target in many countries. Core inflation continues to be sticky, impeding the last mile of disinflation. Major central banks have kept rates on hold while refraining from forward guidance in view of the prevailing uncertainties. Financial markets remain volatile in their quest for definitive signals about the future path of interest rates. Against this unsettled global environment, the Indian economy presents a picture of resilience and momentum. The real gross domestic product, that is GDP growth for Q2 of the current financial year, has exceeded all forecasts. The fundamentals of the Indian economy remain strong, with banks and corporates showing healthier balance sheets, fiscal consolidation on course, external balance remaining eminently manageable, the forex reserves providing cushion against external shocks. These factors, combined with consumer and business optimism, create congenial conditions for sustained growth of the Indian economy. Looking ahead, it is our endeavor to further build on these fundamentals, which are the best buffer against global supply shocks in today's uncertain world. Let me now turn to the decisions and the deliberations of the Monetary Policy Committee, which was held, as you know, on 6th, 7th, and today 8th of December. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, of course, the Monetary Policy Committee decided unanimously to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility rate remains at 6.25%, and the marginal standing facility, that is MSF rate, and the bank rate at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth. I shall now briefly set out the rationale for these decisions. Since the last policy, CPI headline inflation moderated to 4.9% in October from 7.4% in July. The moderation was observed in all components of CPI, namely food, fuel, and core, that is CPI excluding food and fuel. There has been broad-based easing in core inflation, which is indicative of successful disinflation through monetary policy actions. The near-term outlook, however, is masked by risks to food inflation, which might lead to an inflation uptick in November and possibly in December. This needs to be watched for second-round effects, if any. Domestic economic activity is holding up well, as assessed in the previous MPC meetings and as reflected in the GDP growth for the second quarter of this year. Against this backdrop, the MPC decided to keep the policy repo rate unchanged at 6.5%, but remain highly alert and prepared to undertake appropriate policy actions as warranted. Monetary policy must continue to be actively disinflationary to ensure fuller transmission and anchoring of inflation expectations. The rate action so far is still working its way into the economy. Hence, the MPC decided to remain focused on withdrawal of accommodation to ensure that, as I have already stated, to ensure that inflation progressively aligns to the target while supporting growth. I would now like to provide an assessment of the growth and the inflation situation. First, let me focus on global growth in brief. The global economy continues to remain fragile. World trade is decelerating amidst global tide of protectionism. Despite significant restoration of global supply chains, factors like elevated debt levels, lingering geopolitical hostilities, and extreme weather conditions aggravate the risks to global growth and inflation outlook. Easing of inflation in advanced economies has led to expectations of an early end to the monetary policy tightening cycle, shoring up market sentiments. Sovereign bond yields are softening as markets are not factoring in any further rate hikes. Coming to domestic growth, economic activity in India exhibited buoyancy in the second quarter of this year, aided by strong domestic demand. GDP growth, as you would know, posted a robust growth of 7.6% 7.6% in the second quarter of this year, that is 2023-24, driven largely by investment and government consumption. Turning to the third quarter, two-thirds of Rabi sowing has been completed despite late harvest of Kharif crops in some states. Manufacturing sector gained strength with easing input cost pressures and pickup in demand conditions. 8 core industries recorded healthy growth in October and continued their high growth since June this year. The Purchasing Managers Index, that is the PMI for manufacturing, rose in November. The services sector buoyancy has remained intact as reflected in the high frequency indicators which the Reserve Bank monitors. GST collections at rupees 1.68 lakh crore in November 2023 were also buoyant. Services PMI displayed healthy expansion in November. In my statement, there is a lot of data available, which I have put it in the footnote. So those of you who are interested can have a look at the footnotes. The entire data in support of whatever I am saying is available in the footnotes. On the demand side, households' consumption is supported by durable urban demand and gradual turnaround in rural demand, as reflected in sales of fast-moving consumer goods, that is FMCG, and other indicators. Festival-related demand is also spurring household discretionary consumption in the third quarter, that is in the current quarter. Investment activity continues to be aided by buoyancy in public sector capex. This is also reflected in strong growth in steel consumption, cement production, and imports of capital goods. Capacity utilization in the manufacturing sector continues to remain above the long period average. Investments in fixed assets by listed private sector manufacturing companies also registered healthy growth in the first half of 23-24. Primarily driven by key industries such as petroleum, steel, chemicals, and cement. The total flow of resources to the commercial sector from banks and other sources at rupees 17.6 lakh crore during the current financial year so far is significantly higher than that of last year, which was at rupees 14.5 lakh crore. Despite weaknesses in external demand, both goods and services exports returned to positive territory during the month of October, in October this year. Looking ahead, private consumption should gain support from gradual improvement in rural demand, strengthening of manufacturing activity, and continued buoyancy in services. The healthy twin balance sheets of banks and corporates, high capacity utilization, continuing business optimism, and government's thrust on infrastructure spending should propel private sector capex. The drag from external demand is also expected to moderate with a turnaround in merchandise and services exports. The protracted geopolitical turmoil, volatility in global financial markets, and growing geoeconomic fragmentations, however, pose risks to the outlook. Now, taking all these factors into consideration, real GDP growth for the current year, that is 2023-24, is projected at 7%. I repeat, real GDP growth is projected at 7% for the current year, with the third quarter at 6.5% and the fourth quarter at 6%. Real GDP growth for next year, and we have provided the figures for the first three quarters of next year. So real GDP growth for the first quarter of 24-25 is projected at 6.7%, for Q2 at 6.5%, and Q3 at 6.4%. The risks are evenly balanced. I would now like to turn to inflation. Food inflation, which was in double digits in July, has since then moderated to 6.2% in October, with correction in vegetable prices. Fuel inflation slipped into deflation since September, primarily reflecting the sharp fall in LPG prices in end August. The disinflation in core gathered momentum during September-October and reached levels last seen in the fourth quarter of 2019-20 due to the combined effect of policy rate increases and reduction in cost push pressures across core goods and services. Going ahead, inflation outlook would be considerably influenced by uncertain food prices. High-frequency food price indicators point to an increase in prices of key vegetables, which may push CPI inflation higher in the near term. The ongoing Rabi sowing progress for key crops like wheat, spices, and pulses needs to be closely monitored. Elevated global sugar prices is also a matter of concern. On the positive side, global commodity prices, particularly agricultural commodities, have softened except rice. For highly import-dependent food items like edible oils, international prices continue to remain soft. Domestic milk prices have stabilized. Proactive supply-side interventions by the government are also containing domestic food price pressures. Crude oil has softened considerably, though it may remain volatile. Taking into account these factors and on the assumption of normal monsoons, CPI inflation is projected at 5.4% for the current year, that is 2023-24, with the third quarter at 5.6% and the fourth quarter at 5.2%. CPI inflation, and here again we are giving for the first 3 quarters of next year, CPI inflation for the Q1 24-25 is projected at 5.2%, Q2 at 4%, and Q3 at 4.7%. The risks are evenly balanced. Now, what do these inflation and growth conditions mean for monetary policy? Let me provide our assessment. We have made significant progress in bringing down inflation to below 5% in October 2023, despite occasional blips due to intermittent supply shocks. The summer of 2022 is behind us. Our policy of prioritizing inflation over growth, hiking the interest rates, that is policy rate, by 250 basis points in a calibrated manner, and draining out excess liquidity have worked well, alongside supply-side measures taken by the government to bring about this disinflation. The fact that core inflation has also trended lower and household inflation expectations have become better anchored gives us the confidence and conviction that monetary policy is doing its job. On the other hand, growth remains resilient and robust, surprising everyone on the upside. Notwithstanding this progress, the target of 4% CPI is yet to be reached, and we have to stay the course. Headline inflation continues to be volatile due to multiple supply-side shocks, which have become more frequent and intense. The trajectory of food inflation needs to be closely monitored. Intermittent vegetable price shocks could once again push up the headline inflation in November and, as I said, possibly December. While monetary policy would look through such one-off shocks, monetary policy has to stay alert to the risk of such shocks becoming generalized and derailing the ongoing disinflation process. In the midst of these uncertainties, monetary policy has to remain actively disinflationary to ensure a durable alignment of headline inflation to the target rate of 4% while supporting growth. I would now like to focus on the liquidity and financial market conditions. Like most other central banks, The Reserve Bank had injected additional liquidity into the system to counter the COVID-related onslaught on our economy. Consequently, the size of the Reserve Bank's balance sheet had expanded significantly. Persistence of such expanded balance sheet far too long could have created macroeconomic and financial instability. It is worth noting that the Reserve Bank has successfully reduced its balance sheet size well in time. Illustratively, the size of Reserve Bank's balance sheet swelled to 28.6% of GDP in 2020-21. With modulation in liquidity in the post-COVID period, the balance sheet size moderated to 23.3% of GDP in 2022-23 and further to 21.6% in the current financial year up to December 1. We consider this as a significant achievement. System liquidity as measured by net position under the Liquidity Adjustment Facility, that is LAF, turned into deficit mode for the first time in September this year, after a gap of nearly 4.5 years since May 2019. Deficit liquidity conditions persisted during October and November, prompting large recourse to marginal standing facility, that is MSF, by the banks. In parallel, utilization of standing deposit facility, that is SDF, has also been high. The overall tightening of liquidity conditions is attributed mainly to higher currency leakage during the festive season, government cash balances, and Reserve Bank's market operations. Driven by these autonomous factors, system liquidity tightened significantly compared to what was envisaged in the October policy statement. Consequently, the need to undertake auction of OMO sales has not arisen so far. The evolution of liquidity conditions has been in alignment with the monetary policy stance. More recently, however, as government spending has picked up and system liquidity has got more evenly balanced among market participants, pressures have eased and the net LAF position has evened out broadly. Going forward, government spending is likely to further ease liquidity conditions. On our part, the Reserve Bank will remain nimble in liquidity management. Now, different segments of the financial markets have witnessed monetary transmission of varying extent. Long-term G-Sec yields have softened, reflecting strong demand for these bonds from financial institutions and softening of global bond yields. In the credit market, monetary policy transmission is still working its way through the system, and the supporting data is provided in the footnote. With regard to standing facilities of the Reserve Bank under the LAF, we have noticed, as I pointed out, we have noticed simultaneous high utilization of both MSF and SDF by the banks. This was also pointed out by me in the last monetary policy statement. We propose to address this situation and have therefore decided to allow reversal of liquidity facilities under both SDF and MSF even during weekends and holidays with effect from December 30, 2023. This is an important announcement so far as the banks and the liquidity situation is concerned. So let me just read it again. We have decided to allow reversal of liquidity facilities under both SDF and MSF even during weekends and holidays with effect from December 30 this year, that is December 30, 2023. It is expected that this measure will facilitate better fund management by the banks. This measure will be reviewed after 6 months or earlier if needed. The Indian rupee has exhibited low volatility compared to its EME peers in the calendar year 2023, despite elevated US Treasury yields and a stronger US dollar. The relative stability of the Indian rupee reflects the improving macroeconomic fundamentals of the Indian economy and its resilience in the face of formidable global tsunamis. Recently, the Reserve Bank and the Bank of England have signed a memorandum of understanding on cooperation and exchange of information relating to the Clearing Corporation of India, which is a central counterparty that is regulated and supervised by the Reserve Bank. The MOU will enable the Bank of England to assess CCIL for recognition as a third country CCP, that is central counterparty, for UK-based banks to clear their transactions through CCIL. This MOU is based on the principles of mutual cooperation and trust among the regulators of both the countries, that is India and England. We hope the regulators of other jurisdictions also accept these principles. Financial stability, I would now like to just focus briefly on the aspect of financial stability. Financial stability, as we have stated before, is a public good. The Reserve Bank judiciously uses micro and macroprudential tools to safeguard financial stability. The recent preemptive measures taken by the Reserve Bank in respect of banks and NBFCs were geared towards addressing potential risks and preserving the resilience of the financial sector. We do not wait for the house to catch fire and then act. Prudence at all times should be the guiding principle, should be the guiding philosophy, both for the regulators as well as the regulated entities. I now propose to turn to the external sector. In October this year, both merchandise exports and imports came back to the expansionary zone. Services exports remained buoyant during the second quarter of this year. India has remained the top remittance receiving country. The net balance under services and remittances is expected to partly offset India's current account deficit and keep it within the parameters of viability. On the financing side, foreign portfolio investment, that is FPI flows, have seen a significant turnaround during the current year, with net FPI inflows of $24.9 billion up to December 6, as against net outflows in the preceding 2 years. Net foreign direct investment, that is FDI, on the other hand, moderated to $10.4 billion in April-October this year from $20.8 billion a year ago. Net inflows under external commercial borrowings, that is ECBs, and non-resident deposit accounts are, however, much higher than last year. India's external vulnerability indicators exhibit higher resilience in comparison with EME peers, as well as since the taper tantrum period. India's foreign exchange reserves stood at $604 billion as on 1st December 2023. We remain confident of meeting our external financial requirements comfortably. I would now like to announce certain additional measures. First one relates to review of regulatory framework for hedging of foreign exchange risks. The regulatory framework for foreign exchange derivative transactions was last reviewed in 2020. Based on market developments and feedback received from market participants, the extant regulatory framework for forex derivative transactions has been refined and consolidated under a single master direction. This will further deepen the forex derivatives market by enhancing operational efficiency and ease of access for the users. The next announcement relates to framework for connected lending. The extant guidelines on connected lending are limited in scope. It has been decided to come out with a unified regulatory framework on connected lending for all regulated entities of the Reserve Bank. This will further strengthen the pricing and management of credit by the regulated entities. The next announcement relates to regulatory framework for web aggregation of loan products. The Reserve Bank had introduced the regulatory framework for digital lending in August-September 2022. The digital lending ecosystem also comprises of services that aggregate loan offers from various lenders, and this is called web aggregation of loan products. Now, this is meant for the guidance of the customers. It enables the customers to decide which loan product to opt for. Several concerns relating to such web aggregation of loan products which harm consumers' interest have come to our notice. It has therefore been decided to lay down a regulatory framework for web aggregation of loan products. This is expected to result in enhanced customer centricity and transparency in digital lending. Next announcement relates to setting up of a fintech repository. Financial entities like banks and NBFCs in India are increasingly partnering with fintechs. For better understanding of developments in the fintech ecosystem and to support this sector, it is proposed to set up a fintech repository. This repository will be operationalized by the Reserve Bank Innovation Hub in April 2024 or earlier. Fintechs would be encouraged to provide relevant information voluntarily to this repository. The next announcement, there are two announcements relating to UPI. The first announcement relating to UPI is for enhancing the UPI transaction limit for specified categories. The limit for various categories of UPI transactions have been reviewed from time to time. It is now proposed to enhance the UPI transaction limit for payment to hospitals and educational institutions from rupees 1 lakh to rupees 5 lakh per transaction. This will help the consumers to make UPI payments of higher amounts for education and healthcare facilities, for education and healthcare purposes. The second announcement relating to UPI relates to, it relates to e-mandates for recurring online transactions. It's actually, it's a much broader announcement. It relates to e-mandates for recurring online transactions, and specifically it focuses on enhancement of limit for specified categories. E-mandates for making payments of recurring nature have become popular among customers. Under this framework, an additional factor authentication is currently required for recurring transactions exceeding rupees 15,000. It is now proposed to enhance this limit to 1 lakh rupees per transaction for recurring payments for mutual fund subscriptions, insurance premium subscriptions, and credit card repayments. This measure will further accelerate the usage of e-mandates. So strictly speaking, this is not a part of UPI alone. It's a wider, it has got wider ramifications. And the last announcement that I have, it relates to establishment of a cloud facility for the financial sector in India. Banks and financial institutions are maintaining an ever-increasing volume of data. Many of them are utilizing the cloud facilities for this purpose. The Reserve Bank is working on establishing a cloud facility for the financial sector in India for this purpose. Such facility would enhance data security, integrity, and privacy. It would also facilitate better scalability and business continuity. The cloud facility is intended to be rolled out in a calibrated fashion over the medium term. I would now like to conclude. In a global economy clouded by uncertainties, monetary policy actions and communication can be a stabilizing force by anchoring the expectations of economic agents. Clarity and consistency in action and communication is a time-tested principle for effective monetary policy. Policymakers have to be mindful of the risk of being carried away by a few months of good data, or by the fact that CPI inflation has come within the target range. They have to be also mindful of the risk of over-tightening, especially when large structural changes, geopolitical and geoeconomic shifts are taking place. On top of this, they have to be watchful of the risks from new shocks that could hit the economy from anywhere, anytime. We have now reached a stage when every action has to be thought through even more carefully to ensure overall macroeconomic and financial stability. More so because the conditions ahead could be fickle. We have to remain vigilant and ready to act as per the evolving outlook. India is better placed to withstand the uncertainties compared to many other countries, as the Indian economy trades the path, let me repeat, as the Indian economy trades the path to a brighter future. I recall the wise words of Mahatma Gandhi, and I quote, "Progress is absolutely assured whenever there is an unalterable determination." Thank you. Namaskar.
Well, that's the RBI governor. A few key takeaways, all flashes on your screen already. FY24 real GDP growth at 7%. Repo rate unchanged, by the way, first one. Real GDP growth rate at 7%. So that number has been upped even for the periods ahead. 5 out of 6 members vote in favor of continuing stance. And let me get in our experts without further delay. Somebody who's always with us after every policy, and we love having her. Tanvi Gupta Jain, economist at UBS, joins us, as does Jaideep Iyer, head of strategy at RBL Bank. Both of you, thank you so much for joining in. It's special because it's the launch of NDTV Profit today. So great to have both of you on the show. Tanvi, I'll start off with you. Throughout the 32 minutes that I heard the RBI governor, there were sprinklings of how the inflation expectations are looking a lot more benign than what they could. And at the end, the RBI governor making a comment that the central banks need to be conscious of risks of over-tightening as well. What stood out for you, by the way?
I think the policy was not as hawkish as I was expecting. I would say there was a cautious undertone, but overall policy seemed largely balanced. In fact, slightly bullish, I would say. I mean, they have revised their GDP growth estimates higher. For FY24, RBI is now estimating GDP growth at 7%. Inflation, they have retained the forecast at 5.4%. They did signal that inflation will edge high in the months of November, December, largely because of food prices. But overall, it looks like they have there's a tight leash on inflation. Very interestingly, I would say that, what we were expecting the policy tone to be a lot more hawkish. I think it was a lot more balanced and slightly on an optimistic front. Clearly, they have not changed, they remain focused on withdrawal of accommodation stance. I think 5 out of 6 members voted in favor of continuing stance. In that sense, it is largely on expected lines. On the liquidity policy, they clearly said that they have refrained from using open market operations so far because liquidity in the system has been tight, but they did come out with something to improve or all those reversal of liquidity facilities and the SDF and marginal standing facilities even during the weekdays and weekends and the holidays with effect from December 30th. So it looks like that they want better fund management for the banks. So I would say at this point, looks like on expected lines, but definitely a big surprise on sharp revision in GDP numbers, a lot more higher than even where the market is expecting in our base case.
Yeah, well, and significant progress in inflation management. Summer of 2022 is behind us. A lot of bullish statements there. Jaideep, we usually used to have you in our studios. Next time, I hope to see you here. But be that as it may, thank you for joining us today. Your opening comments.
Thanks, Mitch. Yeah, Neeraj, good to see you again. No, I guess I would agree largely. I think while the governor did make the statement of actively disinflationary in terms of stance, but I guess there were many comments which did look like it was quite more balanced in that sense. And I think we are fortunate to be in an economy which is showing such signs of strength. I think, yes, we were all surprised by the level of upward revision. We all knew there will be some upward revision on GDP, but this was quite a strong upward revision. So yes, I think, and I think even the from a liquidity standpoint, I think it's been I guess in the last policy when the governor used the term OMOs, there was some level of let's say panic, but I think it's been fairly well maintained in terms of it's been balanced, and I think, yeah, I mean, I guess we've seen that in the GSEC rates coming off. Of course, the short-term rates are hugging closer to MSF rates, and that's by design. So yeah, all in all, I think nothing to worry about. It's been a good outcome.
Yeah, nothing to worry about. Just wondering, I mean, Tanvi evoked that point as well, this whole reversal of liquidity facilities, SDF, MSF, even on weekends. How material would it be from a banking perspective, Jaideep, or not quite?
I guess it is. I guess the one good thing is that they have now opened up the window for Saturday and Sunday, so
right.
It just helps banks manage liquidity with that much more nimbleness, which always means that you don't need to be over budgeting for liquidity over weekends. So marginally positive there to be able to manage. And in general, I think liquidity has been managed within a reasonable tight range. I think we're now again back to positive territory because of government spending. But in general, I don't think we've seen panic on short-term rates at all.
Okay. Tanvi, is it my thought, or did the governor, despite talking about risk due to maybe higher global sugar prices, otherwise so on and so forth, sound unequivocally comfortable about inflationary pressures? I mean, he said that food inflation has moderated, disinflation in core has gathered momentum in September, October, global agri prices despite sugar have softened, significant progress in inflation management. Like I said, there was a sprinkling of disinflationary or inflation contained comments throughout the 30 minutes. Is it my imagination, or did you feel that too?
You and I felt that too. I mean, every time RBI was highlighting the upside risk to inflation, even though they're maintaining the forecast of 5.4, but every time you would see that there are some sequential prices which we are seeing are on an uptick in cereals, in other components of headline CPI inflation. This time, surprisingly, RBI didn't mention anything about that. I thought they were a lot more sanguine. They accepted the fact that inflation is going to go up in the months of November, December, but then it will going to come back within the estimates that RBI has already provided. So I think this was a very, very balanced and policy, a lot more on an optimistic front rather than a lot more hawkish that I think the market was expecting, especially after very strong GDP numbers. So in that sense, I think they were very robust about the growth outlook and very sanguine about the inflation outlook. Looks a little contrary, to be very frank, because if I look at Rabi sowing or the winter crop sowing, it's still lagging 5% year on year versus last year. If I look at the first advanced estimate of summer crop sowing, they're down 4.5% year on year. If I look at the election manifestos of the recent state elections which got concluded, they are definitely and clearly on the populist side, and which may at some point will be inflationary, even though not from a next 6 months point of view, but as these state budgets get finalized for next year and they start implementing the poll promises, there is going to be an upside risk on inflation. And I think the policy didn't mention anything of that, any risk related to upcoming election, any risk related to populism bias, which we saw in the election manifestos of the winning party. So a lot more sanguine than ideally I would have expected the policy to be.
Well, the policy kind of reflects what the market has felt in the last few days as well, Tanvi, I have to say. I mean, the markets have been completely sanguine about that aspect as well. So any surprises, Jaideep, to your mind that came in from the statements? I know we've spoken about how the growth numbers seemed a bit of a surprise on the upside. Who knows? We may actually do better than that also. I mean, who knows? Cross fingers. But on the inflation front, that was a surprise to me. Anything that surprised you in all the statements that have come out, whether in terms of measures or in terms of the opinion that the MPC has expressed?
No, I think not really. I think other than the positive undertones that we are all talking about, I think it was pretty much in line. I think the RBI also mentioned the fact that the macroprudential measures taken a couple of weeks back on increasing risk weights was also not because they are effectively seeing something bad already happening. It is more preemptive, and which is what I think all of us also felt when the policy was announced. And it's the right thing to do. In good times is when you need to take measures which will ensure that we don't go overboard in terms of wrong kind of growth from a system perspective. I think he also referred to, from a regulatory standpoint, he spoke about digital guidelines which had come over a year back, and now, unfortunately, from a fintech standpoint, innovations which, according to the RBI, are possibly bad for the consumer in terms of mis-sell, etc. I think they are quite very, very conscious of that, and therefore some guidelines around web aggregation, which is again trying to ensure that wrong practices or wrong kind of business models for even fintechs don't come and harm the consumer in any way. So I think, and those have been the focus. If you look at the governor's speeches in between two monetary policies, from a regulatory standpoint, I think they're really, really focused on, from a bank standpoint, they're focused on customer service, customer transparency, and I think there are some steps in that direction as well. So, nothing surprising there. I think more will follow as and when they see any wrong things happening on such fronts.
Yeah, on the lending front, it's not just the policy meet today, but the comments that have come in all through the last few weeks, if you will. Yes, the markets would argue that Vijay Shekhar Sharma knows it best, and it's evident in the way the comments that they've given. But yeah, it's true for some of the others too. Tanvi, just one quick factor before we slip into a break, and on the other side, we'll also be joined by Arvind Chari. Tanvi, one quick thing. I heard you say that the growth numbers are surprising from the looks of it. Everybody was talking, and the inflation numbers on the on some counts. The point about, all before the policy, the market's been fretting about reservoir levels, about the erratic rainfall and the impact that it could have on certain aspects. But the RBI has consistently maintained all through the last few that we are cautious about what's happening to domestic food inflation. And therefore, at some point of time, certain market participants believe that there should have been a call taken, but the RBI did not, because they said we want to watch what's happening to food inflation very closely. If they are going ahead and now saying that it's not as big a worry, do you take it at face value?
I would say at this point, I would definitely take it at a face value, because what happens is that even if you say that Rabi output or the winter crop output is lagging, it will start showing up in numbers in next year, not in the next 3 months, because that supply comes into the market from March onwards. And RBI seems to be only focusing on inflation. Specifically, if you look at for the next 3 to 6 months where the market focuses. If you look at my next inflation numbers for FY25, we are at 4.8%. RBI is at 4.5%. So we have definitely taken into account some lags in sowing in winter crop, having an effect on the market supply. We have taken into account the populist spending, which is measures which are being announced by states, having some inflation impact. So we are definitely 30 basis points higher than where RBI is on inflation forecast for next year. But at this point, sitting today, I would say the near-term inflation risks are coming mostly because of onions or elevated tomato prices. But other than that, whatever we are seeing on the busy election calendar and its effects on the inflation expectation, I think that will all come with a lag. So I think I'm okay with now at this point, we're at 5.5% inflation forecast for India for FY24. RBI is at 5.4. So largely on the similar, I would say similar levels, 10 basis point here and there will not matter. I think where I would be more worried about is at FY25, where we are 30 basis point higher than where RBI is at the current juncture.
Got it. We'll take in final comments from both of you after this very quick break. Please stay on. Just one final comment from both of you. Also joining in the conversation would be Arvind Chari. Stay tuned, viewers. We'll be right back. Arvind, hi, can you hear me?
Yes, I can hear you.
How early is this for you, Arvind?
This is 5:20.
My goodness, which geography are you in?
I'm in London.
London only. Okay, fine. घर पे ही हो आप, ठीक है? So CIO.
Yesterday I had a late night. I had a travel, so I came back very late yesterday. But Good.
Right, back with the monetary policy coverage right here on NDTV Profit. Also joining us on the conversation is Arvind Chari, CIO of Quantum Advisors. Arvind, thanks so much for joining in very early for you. Good morning to you in London. Quick initial thoughts of whatever you've been able to grasp and impact on the markets as well.
I think it was expected to be a hold kind of policy, right, where they hold on rates. There was some discussion on the stance, but they have gone ahead with the retaining this stance as well, which is in their meaning withdrawal of accommodation, which kind of means that I think they will keep removing liquidity over a period of time from the total core liquidity that you see. Banking system liquidity still remains to be very, very, very tight. I think from a general perspective, I think once you hear comments from in the press conference in terms of what is their current outlook of liquidity, because if you look at last two policies, especially for the bond market, they were a bit of shocks in the sense that there was a CRR hike and then there was a mention of OMO sales. How they approach that, what do they talk about it? Because if you look at money market rates have already tightened quite a bit. What we call weighted average call rate is consistently trading 20-25 basis points above the operational rate, which is a repo rate. And if I look at any aspect of money market rates, 3 month, 6 month, certificate of deposits, commercial paper, they're all closer to 7 quarters, 7.5, 7.75. So there has been a significant kind of liquidity-led tightening already in the markets. At a time when you've seen global yields fall, you've also seen Indian headline inflation come down quite a bit. Although there are some worries, and you will see next 2-3 month prints higher because of, again, another vegetable price shock. But broadly, the inflation trend seems to be lower, both globally as well as especially in core inflation terms in India. So I think the market should be, as you can see from the response in the market, it's been very, very range bound. This was supposed to be a very, hold, no major shock surprises kind of market, kind of policy. I agree. I think I just heard Tanvi talk about FY25 inflation, and of course that's a bit too far out. But that will be a worry in terms of if this food price inflation continues to be it continues to give second order shocks. But our broader point, and I'll come to that later, is that household incomes are still fairly, very weak. And so we don't see very high level of demand-led inflation even now.
Okay, and I'll pose that question to Tanvi as well, but I just and in her final comment. But before that, Jaideep, a question to you. Therefore, as a final thing before we let you go, what do you expect? The beliefs of various people have changed in the last month and a half, wherein if the expectations of when does the Reserve Bank of India start its rate cut cycle and what impact it has on various risk assets have moved from December to Feb. For some people, even in June. Morgan Stanley today put out a note saying that we expect the first ones to happen in June. Where are you on this argument, and what is it that you would watch out for in terms of RBI commentary from here until the next MPC meet or somewhere in between?
No, I think in my judgment, I would kind of also put it in that April, May, June time frame before we start seeing any signs of cuts. And I think we will, as a banker, I would really hope that we first see signs of easing liquidity, and the operative rate come down from 6.75 to 6.5 before there is a rate cut. Because on the way up, the banks did enjoy the fact that external benchmark rates on lending went up, whereas the deposit rates came with a lag in terms of increase in costs, which is now happening. And similarly on the way down, that will also again happen, where lending rates will come off sharper, because a substantially large part of the books of banks are now linked to external benchmarks. Whereas the deposit rates will come down with a lag, because you don't reprice deposits only for incremental deposits. And therefore, I would really look for first an easing liquidity before rates actually get cut. But broadly, would look to see where the commentary is moving more and more bullish, like we saw initial signs of comfort on growth and inflation. I think as we see more comfort from RBI on that, is when we can probably budget to start seeing any cuts.
Got it. Jerry, we'll let you go on that note. Thanks so much for being with us today on our first day of the launch. Really, really great to have you.
All the very best.
Thank you so much. Much appreciated and much needed. Tanvi, a point that Arvind raised as well. Could rural household income per se looking wobbly thus far, or at least rural spend looking wobbly thus far, keep a lid on the kind of inflationary pressures domestically that might come out, never mind what's happened on the external factors, part one? And is there a shot in the arm from a rate trajectory perspective? And again, part two of my question, similar, what is it that you would watch out for now, between now and the next MPC, or somewhere in between?
Okay. So let me start with what's happening on rural wages, and especially on the rural income levels. So why we think that the core CPI inflation has been so modest. In fact, it has come down from more than 6% last year. It is now trending below 4%. And one of the reasons is the K-shaped recovery and the rural income levels being muted. Even though our base case expectation is that gradually this gap between the affluent and the not so affluent consumption pattern should normalize, because going into FY25, I would expect the urban consumption levels should begin to normalize, whereas rural income levels should begin to look good, because most of these weather-related aberration leading to lower crop production would be over by FY24. So I would say at this point, a lot of comfortable what RBI is feeling on the core inflation is also partly because the rural income levels have been quite modest, and that pent-up demand when we saw reopening of the economy, all that has normalized, and labor is back. So we are seeing a core services inflation in India has come down, and leading to very muted inflation numbers. But between now and the next policy, I think what we have to focus that inflation numbers are going to go up. From a 5% inflation, which you saw in the month of October, we are estimating inflation at 5.7% for the month of November. The numbers should remain elevated even for the month of December. So between this policy and the next policy, your inflation numbers would be higher. From now until the run-up to the elections, I think from a macro point of view, there are two things which really matter from the policy-making point of view. One, to ensure that growth and momentum in the economy remains reasonably okay. So you are able to sustain a growth which is closer to 6.5% in terms of the quarterly growth profile. And the second is you are able to contain the macro stability risk, whether it is inflation, whether it is current account deficit, or the fiscal situation. And at this point, all these concerns and macro risk seems okay. From a more durable standpoint, where governor kept on highlighting that we want to take inflation down to 4%, and that is where we want the medium-term target inflation to be, barring the June quarter of next year, when there is a very favorable base effect. And I find it very hard to see that on a durable basis, India will be able to have a headline CPI inflation sustaining around 4%, unless global commodity prices correct significantly, especially oil. So I think my end comments will be, I think between now and then, inflation will move higher. Focus will be on ensuring macro stability risks remain contained, and the GDP growth is sustaining at 6.5% between now and in the run-up to the 2024 elections.
Okay, let's see if the RBI forecasts on the GDP numbers turn out to be picture perfect, or who knows, if we have a surprise as well, though I'm sure that won't happen. But Tanvi, so good having you today. Thank you so much for being with us and giving us your thoughts.
Thank you.
All right, that's Tanvi Gupta Jain. And Arvind, that number will always be debatable. I know you said that you want to talk about the rural household spends, if you will, not quite there, and that having an impact on inflation. Tanvi had her own views too. Coming from the background that you bring, I would love to understand from you, what does all of this mean per se for bond markets, and also bring in the external factors, Arvind, considering that 2024 will also have factors like FI flows to emerging markets, and in India's case, the inclusion in the JP Morgan bond index, and whatever impact, little or large, that it may have in the first half.
Let's just talk about that household income
Sure.
perspective. It is not a near thing, right? We've seen household incomes remaining growing at a much slower pace than the broader economy, right? So even if I look at post-COVID, real household incomes have been growing at about 2 to 3% from whatever way you calculate it, as compared to nominal income. So you've seen that impact continuing over a period of time. And the reason I mentioned that is if in the last two policies, especially in the minutes as well, we've seen a lot of monetary policy members talk about net financial household savings and net financial assets. And there is a decrease in the total net financial savings above about 2% of GDP. And that exactly comes from an increase in net financial liabilities, which is people with households and consumers are borrowing more as compared to the growth in their assets. And that is in by and large okay, because India's credit to GDP is still fairly low, right? So there is significant increase that will happen as people get more income and then as they want to consume more items. And it is also better if it is more mortgage driven, because when you buy a mortgage, which means you're buying a house, that has a very high economic multiplier. But if you look at the trend, the non-mortgage is actually much more than, say, mortgage or maybe vehicle loans. And maybe you're seeing an increase in a higher degree of personal loans, which could have prompted RBI to come and increase the risk weights and kind of try and slow down the growth in the credit side. But RBI cannot do much on nominal incomes. Nominal income is a function of economy, and of course, a lot to do with the government, where I think they have buffers to reduce, say, for example, oil prices. If crude prices have been lower, retail prices have not been cut, there is some scope of giving some more what we call consumer surplus back to people. But what RBI can control is real household incomes by controlling the headline inflation. So that's why they seem to be a bit more focused on trying to manage the credit outlook and credit outflow, and also keep the focus on that 4% inflation target as compared to being okay with 5.5, because they have to protect real incomes.
Sure.
Yeah, so you had a question, sorry.
Yeah, no, I mean, sorry, just some paucity of time, but I just wanted to understand, what if, Arvind, relative to your expectations, in the next 6 months, you see a surprise both on the inflation trajectory, let's assume it happens for whatever reason, global, local, whatever, and there is a surprise on the growth numbers as well, because the RBI's projection on GDP much higher than what most people had estimated. What if you see a simultaneous surprise on both? What is the impact then on risk assets per se, and what would your view be then on what the Reserve Bank of India's rate cut trajectory would be? Would it be Feb? Would it be June? Would it be somewhere in between? What's your sense?
I think it's way too early, because look at the way the RBI will have to progress. Add more liquidity or allow more liquidity so that money market rates come down. Change the stance from there, and still in withdrawal of accommodation, they haven't gone to neutral. And then they talk about cutting rates. I think rate cuts are far too ahead. And frankly, I don't think we require too much rate cuts. Even if liquidity situation gets positive, for example, if, as you said, inflation actually goes to that 4% target, and the RBI gets comfortable that over the next 3 to 6 months it will stay there, for example, they will actually start increasing liquidity in the system, which would mean rates will come down, because in India liquidity has a much higher transmission as compared to rates. Of course, now rates are all linked, like most of the benchmark rates are linked to repo rate, so there is better transmission. But liquidity has a far bigger impact in the market rates, and so I think that is where the trajectory will be. If things go completely Goldilocks, where growth is also good and inflation goes to 4%, you will first see a change in liquidity stance, change in the stance of monetary policy, and then a rate cut. So I don't think we should expect rate cuts anytime soon. I don't think it is even a maybe even a April or June possibility. You will see sometime. They will first wait for the developed central banks to meaningfully cut rates and give a forward guidance. If you look at, no central banks gives forward guidance anymore, right? Everybody is very data dependent. So once you get forward guidance from developed central banks, then it'll be easier for emerging market central banks to react. But 6 to 6.5% repo is fairly 20-year average for India, right? So you don't need a majorly lower rates because growth seems to be still holding on. There are some income issues on the consumption income, but it is holding on. From a risk asset, I think if you see flows on the equity side, I think you would see a lot more flows on large cap and maybe some money taken out from mid cap, small cap. So at net level, you might not see much positive flow number in equities, but I think the market will see some polarized activity from getting more money in large cap, because frankly it looks much cheaper than the mid cap, small cap space. In the bond index, I think you should see secular flows. You've seen for the last 2-3 months monthly net flows into Indian government bonds, and especially in the FAR securities.
Yeah.
And that will continue. I think the next trigger will be the Bloomberg Barclays bond index inclusion. If that happens, yes, you'll see some more. But from a bond market perspective, technically, the bond index increases the diversifying buying profile,
right?
But doesn't change much from demand supply, in the sense that the RBI will be a net seller of bonds if there is a very large inflow of foreign bond index. But it's a good thing to happen, as I've written in my note. It is what happened to MSCI India equity in the equity side in the last 20 years. This is that moment for Indian bond markets over the next 5-10 years. So I think something to look forward to.
Awesome. And well, Arvind, we love to see the next piece that you write on ndtvprofit.com. But thank you for waking up so early for us and giving us your thoughts. Really appreciate your time, and have a great day.
Thank you, and all the best. All the very best.
Thank you so very much. We're out of time completely. Just mind you, the PSU Bank Index has come off the cliff in the last 15 minutes of trade. We take a break. My colleagues Hiral and Harsh will take forward all of that action on the next show. Thanks so much for watching.